Now looking at this shilling really coming strong today, but really driven by the tight liquidity, and we have seen it firm to a more than a one-year high against the dollar. On the back of this, is this trend likely to continue?
Since it's driven mostly by a tight market, I mean, there's a lot of demand for cash. I don't think it will hold out long term. This basically what we're seeing is short-term tightness in the money market. But we expect quite a lot of maturities towards the end of March and the beginning of April. So the market should be quite liquid. I mean, we expect the interbank will come off. And this always puts pressure on the downward pressure on the shilling.
Looking at the shilling at this stage, well, hypothetically, it's sitting at 82 shillings to the dollar. Really, with the finance minister having said 2 weeks ago that he has hinted that he wants to see a shilling hitting a ceiling of about 82 shillings. Is it really realistically possible to impose restrictions on the shilling?
Okay, I think in a way the minister took it back, because today what's coming through today is that he indicated that they're more concerned with stability of the shilling than holding it at 82, which in a way you can interpret as taking back his words. Basically, the Treasury and CBK are mostly concerned with a stable shilling, as they've always indicated, between levels of probably 82 to 85. So I mean, that took him off the hook. And I mean, based on that, we should expect the shilling will probably weaken to, I mean, from these highs we're seeing currently.
You touched on this a little bit earlier, talking about the tightness in the money market right now, with the situation not really prevailing towards the end of March with a type of maturities. What type of maturities are you seeing coming through at the end of March?
We expect huge maturities. Levels of about 50 to 60 billion are probably between the end of March and the beginning of April. This should make the market quite liquid. Most of the people who were chasing yields down at the beginning of the year, when we were seeing prime rates at about levels of 20%, I mean, there's a lot of people who went in for the 91-day treasury bill. Most of these are maturing around this time, so we should expect this to ease the pressure on the market.
Looking at the fixed income secondary market, we are seeing a bit of a slowdown there. Why is this?
Basically, everyone, I mean, all the investors were holding their breath for the MPC meeting. I just put it on that. Everyone expected if there was going to be an adjustment to the CBR, downward adjustment to the CBR, as a signal that rates are going to come down. Since the CBR was held where it was, we're seeing the market coming off. And also what happened was there was a market leaders forum meeting late last week, where it came across that central bank indicated that they're really watching the prime rates keenly to control. They want to control basically the decline in rates. They don't want it to race down like it did about 2 years ago. So I mean, with all these indicators coming across, it seems that rates may not come off as fast as initially the market believed. So people are starting to take to slow down, to be more careful of the positions they're taking. I think we also saw the same thing in the equity market. Of course, it was the earnings season which drove the equity market, but also a lot of investors were also taking up positions in anticipation that interest rates would come off, and this would bring investors looking for higher yields back to the equity market. So we've also seen a slowdown. I think you mentioned a bit earlier that the index came off slightly today. Mm-hmm. So basically, the market sentiment is a bit more cautious now going forward, especially as we go into this second quarter.
Looking at interest rates, at what level could we see the central bank cutting interest rates, or level of inflation, could we possibly see the central bank cutting interest rates?
I think it's more than it being a level of inflation. I think it's more to do with the factors that threaten the inflation rate. I mean, if these factors were to stabilize and have a positive outlook, the MPC would feel comfortable in bringing down the CBR rate. And if the effects are felt through to such market, I mean, to all through the market, filter all the way down, we should expect the MPC will be comfortable to adjust the CBR. It's more a matter of the variables involved in that CPI index more than the level itself.
Looking at the central bank once again, it is to issue a one-year bond for the month of March. What kind of demand are you seeing coming through for that bond?
I think there's immense demand for 1 year papers, 1 and 2 year papers. What we've been seeing actually is demand for the 3-month paper has been coming off. Basically, I think people are starting to take into consideration the reinvestment risk they may face by picking up these, 91-day treasury bills around this time. Because what we expect is most of these will mature sometime in towards the end of the second quarter, the beginning of the third quarter, where most people expect rates will have come off. So of course, this really increases your investment risk. So what we're seeing is investors are going in for 1 year papers and 1.5 to 2 year papers. I mean, everyone wants to lock in these yields. If you get a yield of 16, 17, 18% for a year, that's a pretty good return.
Do you still see the central bank still being unwilling to borrow long-term money at current rates?
Of course. I think also that's also an indicator in itself. If the central bank is still issuing a 1 year paper in March after indicating that they were likely to go for a longer paper, it's an indication in itself that they also believe that rates may come off. So why issue a 5 year paper now, which would probably come in at above levels of 20%? Then rather hold off for about a month or two and borrow the same money at levels of 15 to 16%.